Good evening, everyone. Please, can you hear me?
Yes, sir, we can hear you.
Thank you very much. Thank you. Thank you. First of all, I apologize for coming late. Guys, it was a long day. So, very sorry. So, let's get started. I'm seeing some new faces and some new names here. Please, if you are new in this class, can you please signify, please? Just raise up your hand. Let me know if you are new, please. Okay, I'm seeing a lot of hands up. Ayodele Kemi, Omo. Why are there so many people? Anthony Bantai, Ayodele Femi, Yemi, sorry, Ezra. Wow. Wow. This is quite a lot. This is about 6 or 7. So if people are just saying my voice for the first time. If I've missed though. If I've missed a lot. No. Mr. Isaiah, I don't think they've missed. They've missed now. Hearing my voice for the first time. Anyways, Thank you. I just wanted to confirm because I just noticed the name and noticed that I've never seen some names here before. I might not know the names physically, but I know my students. I know the names I've seen before. For people that have been in my accounting software class, whenever I see them here, I always know them. It's not because of it, because I don't know. There's a way I get attached to the names, and I feel like I know people I've seen before. There are some people that I know their faces. Lawa Ibuko Olua, I know she's always in my class. Umar Usman is in my class. So I know my students regardless. Anyways, you're all welcome to class today. First of all, before I start or before I get to what I have to do today, let me do a little bit of introduction first. So for people that are just joining, for the 6 or 7 people that raised up their hands, my name is Laimon Olanshili Omogbola ACACS, and I'm your what am I doing? I'm the one lecturer. I'm one of the lecturers for SFM, the major lecturer for SFM actually for this diet. So roll with me and good evening. So go with me and move with me on the same pace, and we'll all have a successful class. That being said, on the introduction, now let me say something regarding some stuffs, which is the fact that are you people reading? People say my wala is too much. I know my wala is too much, but the only way I can be happy is if you pass, and the only way you can pass is if you read. Are you people reading? Okay, now let's do something. Let's do something real quick. Please, if you've been in all classes for SFM for Apex tutorials, this diet, please raise up your hand. If you've been in all SFM classes, all both my classes, Mr. Olukunle's class and Mr. Idris's class. You've been in all the classes, please raise up your hand. Okay. I'm seeing quite some numbers up. So I'll pick 2 people that you will help me. So Damilola Moreni Kiji and Angela. I need you guys to do me something. Please, just list out the topics we've done. Both for me and from hold on, please. Let me share my screen so I can write them down. Let me just use this part. Let's use this part. Okay, so please just list out the topics we've done, both my part and their part. I know I've done introduction to SFM. Abi,
Yes, sir.
I've done agency conflict. I've done agency conflict. I've
Islamic
done
finance.
treasury management. I've done treasury management. Yeah,
Dividend policy.
I've done
I've done
Islamic.
dividend policy.
Money laundering.
I've done
Islamic
dividend, money laundering.
Islamic finance.
I've written it. I think you guys
Islamic
did business,
finance.
you did business organization. Have you done forecasting?
No.
No.
Not yet.
No.
Okay, so fund valuation, cost of capital. I don't know you're completed, have you? Now, this is where I'm going exactly. When did we start this lecture? Started lectures by, let me say, mid-January-ish. Let me say mid-January, maybe 16, 17. Is it that late? Around that period of
13.
January, anyway, that was around 13th of January. So this is just 1 month. This is where I'm going to. This is just 1 month. See topics we've done. 1, 2, 3, 4, 5, 6, 7, 8, 9. This is 9, 2, 4, 6, 8, 9. This is 9. We've done 9 topics. Today, portfolio theory that we'll do makes it 10 topics that we've done in the space of 1 month. Where I'm going exactly is another 1 month to come that will do another double of this thing. So where I'm going exactly is if you have not started reading, I don't think you are doing well by yourself. All this stress and all this energy is going to waste. Because now we've done 9, we've done 10 as of February. Now, just think about the amount we would have done as a March or as a April. So where I'm going exactly is you need to have started reading by now. You need to start solving questions by now. If I were you, if I was anybody here, we finished bond valuation last week. Anybody that really wants to write this direct exam, please, somebody's unmuted. Anybody that really wants to write this direct exam should have gone to the past questions and brought out all the questions. Somebody's unmuted, please. And bring out all the questions on bond valuation. Then look at the ones you can attempt, the ones you cannot attempt. Start sending them to me now. Where you just start sending them to me. So we'll start looking at. It's not as if it's when exam is now 2 weeks, 3 weeks that people will not be bombarding me with questions. I will not be. I will run away. Yes, now I'll definitely run away. I won't run away. We're about 100. Imagine all the good chats. So imagine everybody sending me questions by that period. Asalo is not. I'm not even denying it. I will run. But if you start sending me now, I can as well be looking at it now with you, and we'll start solving it together as I now because it's comfortable for me. It's no rush. I can still have time. But when it's that period, I want to take a rest too. It's not as if I've been lecturing since last like 2 years back to back. So any small rest I have, I always want to take it. Because immediately after this now, we're going to do accounting software training. After accounting software training, bam, we're back to diet again. So it's a lot. So any small break I have, I want to rest. Immediately I'm done with my part, I'm going on break. So any question you want to ask me, start asking me now. That's what I'm saying. Start asking me now. Like I always tell my previous students, don't send me a blank question. I will not answer it. What I mean by blank question is don't just send me a question and tell me to solve it for you. I will not solve it for you. This is professional level. This is not foundation students. If you send me question to solve, I will not solve. But show me where you are hooked and tell me, okay, well, this is where you don't know what to do anymore. Then we can look at it together. Okay, go back here, do it like this. But attempt it. Put Bible to book first. Don't just send me a blank something and tell me to solve it. What am I, AI? That just going to tell me to go and solve it for you. No, you would have attempted it. Then I will try as much as possible and see, okay, where you got stuck, the mistakes you made, and I'll correct them for you. What I am saying in particular is, that is all I'm saying. Read and pass. That is all I'm just saying. That is the only way you can pass. Please and please and please and please and please. See the way I'm begging you people. Please and please and please read. Solve questions. That's why you have Pathfinders. Pathfinder is from 2014 to 2025 or 2024. Sorry, that's about 10 years. And in each year we have two diets. So that's about 20 past questions for you. There was even one diet we had 3 years. I think that was 2020. We had 3. So that's about 21 past questions for you. 21. Out of that 21, believe me, if you practice most of the questions in that 21 past questions, you are already 50% or 60% ready for exam. And that is all you need. You need 50% or 60% to cross. That is all you need. ICANN is simple. SFM is simple. You just need effort. It needs you to try. Just put effort. Try at least. Try and read and pass. Read smart. It's not quantity, it's like I always say, it's not quantity, it's quality. Don't just be cramming a lot. It's quality. Read though. Into what they mean here. So that's being said. So in case if you've missed any of the classes, I'm just hoping you could have maybe done is you could have snapped all those materials or all those notes. Maybe message somebody on the group chat to send you all the materials, but I don't have all the materials. I know that's where people are going. Everybody will start DMing to send them all the materials. I don't have them. Please, I don't have all the materials as I'm not the only lecturer that took all of them. So please and please and please read. That being said, so last week we concluded bond valuation. Most of you submitted your assignment to me. The ones I could grade, I graded them. The ones I could correct, I corrected them. And I think those are the people that submitted early. And that's what I've said. If you submit early, I'll most likely be able to grade. I think I graded those things on Thursday. I think I was in transit on that Thursday, and I used the opportunity to grade everybody that submitted to me on or before that Thursday. I don't think I've graded anybody after that Thursday. It has been a very, very busy weekend. So I've not really had time to go. But everybody that submitted, that's why I always advise that it's good to submit early before Friday or Saturday. People that submitted, somebody even submitted today. So there's no way I would have graded it. As for me, you know me, I'm chartered now, so I don't need to be looking at all these things. The moment I finish bond valuation, like till learning, yeah, till next day, or maybe revision time, I've deleted it from my memory. Till learning. When I need it, I'll go and transfer it back. But for now, I've moved it to one side of my head. So it's what I want to teach now that I'm bringing to this other side. And all of them is like you store something on your file in my brain. So when I need them, I'll be moving them forward. So I've bond valuation has gone like I've moved that one to the back. I've got another one forward. So anything you need now, I need to start going back to go and bring them. So anyways, that being said, please let me take a few questions before I go to what I want to do today. Okay. I think I'm doing portfolio theory today. So please, if you want to ask me anything, please, very, very fast, please. Very fast. Please raise up your hand. Let me call you if you want to ask. If you have anything to ask me, please. Don't be all this view. I've removed everything now. For people streaming on YouTube, I'm just hoping you can hear me clearly. And I don't think some people still knows how to use this our YouTube thing yet. When I send the two links, please always try to join the Google Meet first. It's when the Google Meet is now full that you can now go and join the YouTube. So people don't know. They just go to YouTube Street and join YouTube. Always try to join the Google Meet first. If you cannot join the Google Meet, then you can go and stream on YouTube. The purpose of the YouTube is in case if the Google Meet class is full. Now I'm serious. I think if people are serious this diet. As of February, this class is still full. Let's see March. As of February, second month, the class will not be filled anymore. But let's still see what's happening. Please, these questions are too much. I cannot take all. I'll just take very few. So, Saida Sonny, please, what do you have for me? I hope it's no questions on bond valuation. I don't delete that. Saida Sonny, please, don't talk to me. Okay. Ezra, please, do you have anything to tell me?
Oh, sorry. I think that's a mistake. Sorry.
Thank you. Oluwatobiloba, what do you have for me? Okay. Most of you are raising up your hand by mistake. Now don't fear me. Oluwatobiloba, do you want to tell me anything? Want to tell me something? Let me know now. Okay, Chuku, what do you have for me? Good evening, ma.
Sir, something means.
Can't hear you.
Can you hear me, sir?
Can hear you now.
I submitted my assignment 3 a.m. last week Tuesday and you didn't check it. I sent it to your WhatsApp.
Depends on the WhatsApp you sent it to. Which one did you send it to?
Okay. The one you used to share this link this night. I sent it through that.
I already told you people now, don't send anything or don't ask me anything. That's my personal number. You don't want to have any personal life. That's my personal number. My lecture and my other number is the other number. Somebody should opt in the chat section, please. But this number, that's why I did not check it, because that number is not for anything relating to lecture. That's the one I used to talk to my people. Eshe.
Okay, sir.
So you can still send if I have time, I'll look at it. Michael, please, the question. Talk to me. Oh yeah. I'm just taking this general observation, general questions. What do you have for me? Let me know.
Good evening, sir.
Good evening, ma. I like the way ladies are asking me questions this night. I'm very happy. Oh yeah.
Sir, sorry, it's about bond valuation. I stumbled on the question on the past question, and I found out that there's a particular question that has the forward rate. Can you please throw light on that forward rate?
Throw light care. Light no deal. Light units don't cost like this to throw any light. Forward rate is edging. It's edging, and when you do edging, I'm sure you would have idea of what forward rates. We have forward rates, we have future, we have money market, a lot. But when you do edging, you have proper idea. But make I throw the light now. I better go. They've increased unit price. But when you get there, I'm sure you understand. I'll find man.
So, sir, what do you say?
What did I say? Okay. I said it is edging. It is edging. Edging, you do forward with futures, money market. So when you get there, you understand better. It's edging is another topic entirely. Like I said, SFM is intertwined. So they can put one inside one. So when you get to edging and you understand edging, you understand the way forward rate works in relation to bond valuation. You understand it then.
Okay, sir.
But now I cannot show light though. If I show light now, it go confuse everybody. So make I leave that light first. Okay,
All right,
Chuku,
sir.
yeah. Okay, Chuku. Okay, Chuku, yeah. Temitayo, please, you want to tell
Sorry,
me
sir.
something?
Sorry, it was a mistake.
Okay, Temitayo, please, you want to tell me something?
Yes, sir. I
Okay.
actually submitted my assignment to your older line,
I'm
but
a long
still you did
loser.
not check it. I submitted on
That's not what I'm.
sir.
But that's not what I'm using this platform for. But anyways, I'll take it. I'll take it. This is just tell me observation. Don't tell me you submitted assignment. I've not checked it. I will check it. I've tried. Well, I'm sure I checked more than 30 or 40, and that's for me. That's a lot. That's a lot. But I still the ones I did not. Some people got it correct, and I told them, okay, you were correct. Because what made the assignment a lot? I think the assignment was about 3 or 4 now. So people not even submitted the previous ones together. So
Yes, sir.
it was actually a lot. But I'm sure I checked the majority. The ones I did not check, probably I skipped them or maybe accidentally overlooked them or something. But when I have a little more time, maybe I'll go back and check it. Maybe I'm not promising. But I'm sure almost everybody that did it correctly. Almost everybody. That's why I'm not bothered. If people didn't do it correctly, I would have. Even the ones I think there was one last one I told you guys to attempt. That one that had flow value, premium, and all those things. And I think everybody that attempted it still did it correctly. If not, I suppose no. Now, if people did not do it correctly, I would have come here and addressed it. So I think people did it correctly. That's why I'm not particularly bothered about it. So, Mr. Anthony, I think that's the last question I'm taking. Oh yeah.
Good evening, sir.
Good evening.
I just have a question concerning the formulas of SFM. Are we going to be giving formulas in the exam? Because I'm seeing from the past videos I'm watching of your lectures, there are so much. Are we going to be giving?
Yes, some formulas will actually be provided for you at the back of your question stuff. But 2 things for me regarding formula. The first thing I would say is, if I were you, I would look at that pack. If you check your Pathfinder, look at look at the formulas that will be provided. So you know the ones to cram and the ones not to cram. So
Okay.
the ones so just look at the ones. Number two, something with me with formula is don't wait or don't me like this. Or I even used to forget that formulas are given at the back. Because I always try to know my own. Why? Like I said, SFM is very, very dynamic. The formula you know, the method you know how to do it might not be the exact way they will write that formula at the back. And if you do not cram your own or you do not know your own, when you get to the exam or you believe in their own and you carry that formula, everything in that solution of that question is already scattered because that is not the one you are used to. Do you get to everything just scatters in your head and it can be a very, very simple question. So that was always advised that, okay, just all these formulas, when you try to practice, you get used to them. You get used to them.
Thank you, sir.
You're welcome. So I think those are the only questions. I don't have any more questions. Let me go into the chat box real quick. Somebody has dropped my number. Okay. Submitted yours on Tuesday and I didn't make corrections. My phone number. Submitted this is visually assignments. Anyways, Mark, you said you have a question. I didn't hear from you. How can I assist people that just joined the class? I don't know how I can do it though. What can I do? I don't know. You can message somebody on the group chat. Anybody should send you. People that have been there earlier to send you all the materials. I think that's best I can do. Just on your platform, just message. I'm sure before you message like about 5 people, you see somebody that started from the group. Somebody will just send you the material, all the materials that have been used, and you already have the YouTube link. The YouTube link is Apex. So I think that is how I think that is how I think that's how best I can help you. So please, enough of bond valuation question. Anyways, people do not ask me all this one. I'm changing you to my, you do not ask me all this one throughout the whole week. It's now that I'm hearing a beg go. Anyways, so I just wanted to use 1 hour, 30 minutes to run through all those things. So let me run through what I have to do today. I'm trying to fire on, please. Fire on, sir. Okay. So no lady, no woman will tell me to fire on. I work for 1 hour for this class. So.
Sir, fire on.
Thank you very much. Thank you, madam. So let's go. So today,
Fire on, sir.
Will you get out? Jumpy. I say, woman. Are you a woman? this Mr. Benjamin.
I just need to laugh so that you know that I'm laughing.
Avoid me. Please, let's start. Don't mind this man. Anyways, so what we have to do today is portfolio theory and portfolio management. Please listen to me very carefully. There are some topics in SFM that normally they are very simple. And that is the best way to pass SFM. You see all those topics that are very, very simple, put them in your left hand. If they come out, fine. If they don't come out, all well and good. So that you can all those other ones that you know that they can come out here, you can. But you see all this bond valuation, portfolio theory, they are just edging. How would I say? They are variables that if any one of them comes out, all well for you. But you see all those them M&A, investment appraiser, all those ones can cost of capital. They can come out in any form. Do you understand? They can come out in any form that if you don't, you can fail. But with the support of all these minor ones, all this portfolio theory, bond valuation, small edging, and all the theories, you can join them together. It's patterning, different pattern. Just be patterning it different way. Those are the ones that can make you pass. Don't just be focusing on the big ones. All these small ones can help. Portfolio theory is a very, very good example of the small topics. So let me list out some of the things we'll talk about in this portfolio theory. And please, the material I sent was actually rushed. So people that went to, I used to tell you that my class is a class that you use to differentiate people that went to I use secondary school and people that went to good secondary schools. Because most of the things I will say from my head are not in that material. Like I said, the material was rushed. Actually, I was not on that portfolio theory last night, so I don't have the material. So the material was I did that material in less than 1 hour this evening. After I go back, I did it in less than 1 hour. So it's not particularly, how would I say it? It's not seasoned. So if you can jot anything from what I would say, fine. And I think that will help you a lot. So let me just say. But along the line, anyone I remember, I'll be saying them. I'll be typing them. So first of all, let me start with, like I said, today we'll be doing portfolio theory and portfolio management. So let me start with portfolio. Everybody used to shout portfolio. What is even the meaning of portfolio? I'm sure everybody has heard the word portfolio before. So what is the meaning of portfolio? Now, anyway you hear portfolio is just, how would I say it? Let me give you an example first before I explain what a portfolio is. Let me just give you a random example. You can open the material and just be looking at it, but all these ones I'm saying are from, I'm just explaining basically from layman term before I go and read all the grammars in the book. Let me give you an example. You can have a basket, a normal basket that used to put oranges. You can have a basket and put one, you can put like one orange in a basket, Abi, and you can put about 3 oranges or 4 oranges in that basket. You see, when the moment you have 3, 4, 5 oranges, that is portfolio of orange. That is a portfolio of orange. So what portfolio simply means is just like a collection of financial assets. Like when somebody has a lot of financial assets, and it does not mean a physical bag, like a bag, no. But like at any circumstance, when any individual has a collection of financial assets, when I mean financial assets, I mean stocks. It can be stocks, it can be bonds, it can be real estate, it can be commodities, it can be mutual funds, it can be anything. So the moment anybody has collection of all these investments, all these assets, the person is said to have a portfolio. Because we have what we call portfolio managers, people that have done SFA. Sorry, for the ACS people that wants to do ACS, actually the chartered stockbrokers. We have it is a part of the ACS to be a portfolio manager. So it's also a particular it's a branch of finance, portfolio manager. So what they do is they manage people's portfolio. So anybody that has all these stocks, commodities, they are all called portfolio, like I said. Now we have types of portfolios. We have what we call aggressive portfolios, we have what we call defensive portfolios, we have income portfolios, we have balanced portfolios, we have speculative portfolios. Aggressive portfolios, that one basically focuses on high stock. Defensive portfolios, low risk assets. But anyways, all those types of portfolios are not particularly very important to the course of our class. Now let's move on to what we call portfolio management. I've explained what we call portfolio to you. Now, what do we refer to as portfolio management? Now, I've explained how portfolio works for you. The company that you people work, most of you that work in a company, it is part of somebody's portfolio. You get only if you are working in government, but the companies you work, it is part of somebody's portfolio. It's part of somebody's investment. It's part of somebody's asset. So it is somebody's portfolio. So that portfolio management just simply refers to the process of managing, analyzing, and maintaining a portfolio. I said it refers to the process of analyzing, managing, and maintaining a portfolio. See, the main target or the main aim of a portfolio, like I told you in our first class, that the main reason why we do SFM, the main purpose of SFM is what? Is to maximize return and minimize risk. That is, and to increase shareholders' funds. That is why we are here. To maximize return, increase shareholders' funds, and minimize risk. So that is basically what we are doing with this portfolio management. We are just simply trying to manage, to maximize return, and also minimize what? And minimize risk. So in order to manage portfolio correctly, you need to do some things called asset allocation, asset diversification, period rebalancing, asset monitoring, and the likes. But before we get there, let me mention what we call we also have what we call types of portfolio management. The types of portfolio management, we have four types of portfolio management. We have what we call active portfolio management. We have what we call passive portfolio management. We have what we call discretionary portfolio management. Lastly, we have what we call non-discretionary portfolio management. Let me come again. So we have what we call active portfolio management. Second, we have what we call passive portfolio management. Third, we have discretionary portfolio management. Lastly, we have non-discretionary portfolio management. So for active portfolio management now, for this active portfolio management, how would I say it? Portfolio managers. This is for portfolio managers now. They actively buy and sell assets to outperform the market. That is, the portfolio management, they are active in the market. They constantly buy and sell the assets. That's what we call active portfolio management. But passive portfolio management now, all they do is they just track the index. They don't necessarily do frequent trading. Do you understand? They don't necessarily buy and sell assets. They just track indexes. That is what passive portfolio management is saying. The third one is discretionary portfolio management. Here now, a professional portfolio manager, he uses his own discretion to make investment decisions on behalf of the investor. Are we together? I'm speaking grammar. I said that for a discretionary portfolio management. For this one, a portfolio manager, a professional portfolio manager, he can make investment decision with his own discretion on behalf of the client. That is what discretionary portfolio management is saying. Then lastly, we have non-discretionary portfolio management. Here now, you see that professional manager, he cannot use his own discretion to make investment decision. It is only the investor that can make final decision. Only the investor that can make final decision. So that is basically what non-discretionary portfolio management is saying. This now leads me to the next one, which is the key principles of portfolio management. The key principles of portfolio management. Key principles of portfolio management, we have what we call asset allocation. Asset allocation. Asset allocation is simply saying it's just the basis of you distributing your investment across asset classes. I said it's just basically you distributing your investment across asset classes. When I mean by asset classes is okay, we have types of stocks. So you distributing your stocks on that stock market. We have bond. You buying different types of bond. You can buy government bond, different type of bond, under bond. In real estate, you buying different types of real estate. You're buying estate in Ibadan, buying estate in Lagos, buying estate in Port Harcourt under the real estate market. So you're allocating your assets under a particular asset group. That is what asset allocation is saying. I'm talking about principles of portfolio management now. Next, we have what we call diversification. Diversification is a subtopic on its own. So please, when I get to diversification, I will explain what I mean. We have diversification, but diversification is simply saying you are just investing in different industries. Like you're not focusing on just one. You're not focusing on just stocks. You're not focusing on just bonds. You're not focusing on just real estate. You're not focusing on just mutual funds. You are investing in different things. That's what diversification is saying. Next is risk management. Basically, how to manage your risk, how to mitigate. You know what risk is now. Risk is not a good thing. Risk is negative. Risk is just the probability of you losing something, the probability of you losing either money or whatever it is. That is what risk is. So how to manage your risk management means how to mitigate the potential financial losses. That is what I'm just speaking grammar. I'm just speaking the theory part. Don't worry, you understand. So that is just risk management. The next is performance monitoring. Performance monitoring is simply just talking about how you can regularly review your portfolio performance. That is, which of this is actually making sense? Is it the stocks? Is it the bonds? Is it the real estate? Which of them is giving me higher return? So that's basically what principles of asset management is saying. Now, leads me to the next now I want to talk about, which is the theories of portfolio management. This one has come out before. It has come, I think, November, 1 year. I didn't know November, maybe 2015 or 2016 or 20. I'm not so sure. But this particular question has come out before. So theories of portfolio management now. You guys know what theories means now. Theories just means what somebody somewhere has formed. That's basically what theory means. Now, what somebody somewhere has developed. So theories basically assumptions of what this should be. So we have three major theories of portfolio management, of portfolio theory. We have three major I don't think that's in the material. We have three major theories of portfolio management. We have the first one, we have what we call efficient market theory. The second one, we have what we call random market theory. We have what we call random theory. Lastly, we have what we call modern portfolio theory. The first one is efficient market theory. Second one is random theory. The third one is modern portfolio theory. Let me explain them one by one. So what we mean by efficient market theory? What efficient market theory is? The person that did that efficient market theory, the person's belief is that when you get to stock market here, when you get to stock market or stock trading, when you get to stock trading, the person that did that efficient market believes that all stocks, together, the person believes that all stocks should be shared or should be sold at their fair value. The person believes that all shares or all stocks should, and on no occasion should any stockbroker, should any broker or anybody, should the person sell at an inflated price or buy any stock at an undervalued price. Now anybody can go to the stock market. You can buy an undervalued stock, but that is not the belief of the efficient market theory. The efficient market theory is saying nobody should outperform the market. No broker should actually outperform the market. That is, when you go to the market, you need to buy at a fair value. You cannot buy any undervalued stock, and you cannot sell at an inflated price. That is basically what efficient market. It needs to be very efficient. Don't sell any inflated stock, and don't buy any undervalued stock. Buy all your stock at the fair value. For this now, this needs some information. It needs some information. So there are informations required to to properly how would I say it? What's the English now? To properly utilize an efficient market theory. The three informations we have what we call the weak efficiency. I'm talking about informations basically to properly utilize efficient market theory. We have what we call weak efficiency. We have what we call semi-strong efficiency. Lastly, we have what we call strong efficiency. I said we have what we call weak efficiency, we have what we call semi-strong efficiency, then we have what we call strong efficiency. Good. When I say weak efficiency, what weak efficiency is simply saying is, okay, for this type of stock, they only give you past informations. That is why it is weak. So if you want to buy, let's say you want to buy a stock of Dangote, if the stock is weak, all the informations you have will only be past information. That is, they will tell you in 2018, they increased by 50%, in 2019, increased by 60%, but all the informations you have are past. This particular thing I'm telling you has come out in ICANN question before. If you have checked Pathfinder at some point, you would have seen it. Weak, strong, semi-strong efficiency, you would have seen it if you have checked Pathfinder at some point. So what I'm saying is, whenever you see weak efficiency, it means that all the informations relating to that particular stock or to that particular, they are all past informations. That is what weak means. Then for the second one, semi-strong efficiency. What semi-strong efficiency is simply saying is, okay, all the informations you have to that particular stock, they are past informations and also public informations. Chamber, they are past informations and they are also public informations. Those are the informations that relate to that particular stock that you can get. I'm talking about semi-strong. Then thirdly now, it is the strong efficiency. This one is very, very strong. It is very strong. So for that particular stock, you will get what? You will get past informations, you will get public information, then you will not get insider information. You get past information, you get public information, then lastly, you now get insider information. So that is what a very, very strong efficiency is saying. So that is basically what efficient market theory is basically telling you. Efficient market theory, that is what it's basically telling you. Then the second theory is your random theory. Random theory is simply just telling you that, okay, stock prices, like they move randomly. Do you get? Like it's not as if it can be fair value or anything. You know, that person will tell you that, okay, they should all be, nobody should buy undervalue, nobody should sell. But what modern theory is saying is prices are random. You can just go and pick any random price. That's just basically what that is saying. Then the last one, the modern portfolio theory. What modern portfolio theory is letting you know is that, you see, for any level of investment or any level of investment that you take, a particular, for any level, even if it's small investment or any level of risk, let me use risk, any level of risk that you take, a particular amount of return should be attached. That is just what modern portfolio theory is saying. That for any level of risk taken, a particular amount of return should be, and that is normal. That is normal. We are all taking risk. We are all taking risk to what? We are all taking risk to maximize our return. You know, the higher the risk, the higher the return now. So, but modern portfolio is saying even if it's the smallest risk that you take, a particular return should be attached. I hope that is clear. I said efficient market theory. Efficient market theory is telling you that no stock, for any stock that wants to be traded, all stocks should be traded at fair value. That no broker should outperform the market. That is, you should not buy any stock. That is, you should not sell any inflated stock, and don't buy any undervalued stock. For whatever return you want. If you want any additional return, you can get additional return by buying undervalued stock now. If you buy a stock that is undervalued, you can make higher return. But that's not what efficient market. Efficient market is say that don't buy for any additional return you want to go and take extra risk. Am I speaking English? I'm not sure Yoruba. Efficient market theory is saying if you want any additional risk, instead of you to go and sell inflated stock or go and buy undervalued, go and take extra risk. That is, either you go and buy more investment, but you need to take extra risk. That is what efficient market theory is saying. For random is saying, okay, all these stock values should be random. They are just there. They should be random. For modern portfolio theory, modern portfolio theory is saying, okay, for any level of risk taking, any level at all, a particular return should also be attached to it. And for modern portfolio theory, there are some assumptions. There are some assumptions of modern portfolio theory. Assumptions of modern portfolio theory. The first one is all investors are risk averse. Yes, now all investors are risk averse. That is, it is assuming that no investor in this life like risk. Yes, now all investors, they are what? They are risk averse. The second one, they are just basic four assumptions under modern portfolio theory. The first one is all investors are risk averse. The second one is saying all investors are also rational. The man, how would I? What's rational in Yoruba? This one is for the deep Yoruba people. Anybody that knows, please tell me or put it in comment section, please. He's saying and all investors, they are rational. Thirdly, he's saying all investors they should have access to all informations. Say, no, God of mercy, it's good to know SFM. It's very, very good to know SFM. The last time I opened portfolio, I don't even teach portfolio theory last night. I don't teach portfolio theory last night. I think the last time I taught portfolio theory was May. It was May 2023. That was the last time I taught portfolio theory. It was Mr. This man that taught portfolio theory last night. And see the way he's still sinking. God, I beg you. So I should come and borrow my brain and go and write exam small or borrow my knowledge and go and write exam. You'll be paying me monthly.
Yes, sir.
I cancelled the assignment.
Sure. Thank you, sir.
So please, can you please slow down a little bit?
Hello, please, can anyone hear me now?
Yes, sir, we can hear you, sir. But please, sir, can you slow down a little, please?
I'm slow. Now, let me come again with the assumptions of the modern portfolio theory. So I said the first one means that the first one is saying that investors are risk averse. The second one is investors are rational. The third one is investors should have access to all information. It's not as if somebody wants to invest, you are keeping the bad part of your investment for the person. No, you should have access to all information. The last one is all returns should be distributed. All returns should be distributed. That is, if the investor makes profit, please share or give the person's money to the person. So that's basically what that is saying. What's the meal? To this point, I hope I'm clear. Now, like I said earlier, I said, Mr. Benjamin, can I help you?
Yes, sir. Sorry, please. I lost the point you gave on the second type of portfolio management. That's the passive portfolio management. Please, I don't know if you could help us take that again, please.
Take what? Anything that
Passive portfolio management. Passive. The
is anybody
second
that
one, passive portfolio management.
anybody that jotted passive should write me. I forgot you. I'm just saying the way it's coming. Anybody that remember what I said, but I think a passive is just saying that the portfolio managers they are not actively trading. They most likely just monitor the trade index. They are not into frequent trading. They just monitor the index. I think that's around something like that I said. Cannot exactly remember. But anybody that got it should they track the index ahead. They particularly track the index. They don't do frequent trading. Anyways, now like I said earlier, I said the main purpose of doing all this is to what? Is to maximize your return and minimize your risk. Is to maximize what? Is to maximize your return and minimize your risk. Now let me talk about risk a little. So let me talk about risk a lot. Or let me talk not a lot, a little. So now, what is risk? I've told you earlier that risk is negative. Risk is negative. You can say that risk is just like can be defined as a chance. It's just like a chance that an investor's actual return it will be different than expected when it comes to portfolio. When it comes to portfolio, it is just a chance that an investment's actual return will be different than expected. Risk is majorly a loss. It's just majorly a loss. It is just it is a possibility of losing some of your investments, some or all of your original. It can be all, not necessarily some. People that are invested in MMM, people know what you lost. Some people have not. Some people they've not made it out till today. So what I'm saying is, it's just the risk of losing some or all of your investment. We have two types of risk. This question, whenever they want to test portfolio theory, they like to test this question with it. And it's been long they've actually tested portfolio theory. It's been long. So we are expecting it any diet soon. So we have two types of risk. We have what we call systematic risk and unsystematic risk. We have what we call systematic risk and what we call unsystematic risk. What is systematic risk? Systematic risk is basically a risk that affects all business in an economy. Basically, it is a risk that affects all the businesses from we are doing hairdresser to the barbing salons to the Okada men to the pre-order, pre-order, all of them, regardless of whatever business you are doing, it affects you as long as you are in that particular economy, as long as you are in that particular state. That part is a risk that just affects all the business. Can you guys give me an example? Yeah.
Inflation.
Inflation. Thank you.
Political risk.
Political risk. I will not call it political risk. I just call it maybe political turmoil, maybe political trouble. But don't say political risk. Political risk can be, I don't know, it can be calmed into something else. But political turmoil and
environmental risk.
Exchange.
Environmental
exchange rate.
Natural disaster.
Natural disaster. Thank you very much. You see, all these things that have been mentioned: inflation, political turmoil, natural disaster, pandemic. When COVID came, everybody was indoor. When interest rates as is high like this, everything in this Nigeria is dollar. Everything dollar has gone up. If you want to enter Marua said that dollar has gotten. How dollar take effect? I'm tired of this country. So everything, the exchange rate can also affect inflation, terrorist attack, pandemic. If there is war today like this, nobody would go to anything. So that is an example of a systematic risk. It is an example of a systematic risk. And for this particular systematic risk, it is investors, they pay to avoid this kind of risk. They can pay. Imagine when there was COVID, when COVID wanted to come, do you think them Dangote and all of them, if there was a payment to avoid it, they could have, because all of them ran into loss that period. So it can also be called a non-avoidable risk, non-diversifiable risk, unavoidable risk, and also be called a better risk. It cannot be eliminated through diversification. It can just be hedged against. You can hedge foreign exchange, your foreign rates. You can hedge it. You can hedge for inflation. When you get to hedging, I'm sure you understand what I mean better. But it cannot be eliminated through diversification. I'll soon get to diversification, and so you know what I'm saying. but they cannot be eliminated through diversification. The next, even though I'm still brushing through, I've not gone through the material. The next is unsystematic risk. This is a particular, for unsystematic risk now, it's just a risk that affects or that is specific to a particular industry or company. It is just a risk that is particular or specific to a particular industry. Example, music industry now. Any risk that is specific to them is their own. Let me say maybe the recycling industry. Anyone that is specific. Now they say Mr. Tinubu came and he said there will no longer be GS1, Abi, is it SS1, SS2, SS3. There's no GS1, GS2, GS3, SS1, SS2, SS3. So just I don't even understand what that scenario is. But all the school industry are particularly affected with that particular new change, because people that now have GS1, GS2, GS3 now, I don't know, it's a lot of things that is going to happen in that particular scenario, in that particular ambience. So that's an example of unsystematic because it only affects people in that industry. Do you understand? If something happens in the music industry now, we think concern music industry with people in education industry or people in pure water industry. So examples of those risks are regulatory changes. Maybe there's changes in the regulation. Maybe they say don't do this, but it can only affect. My voice is breaking, okay? Maybe because I never chop. Anyway, as I was saying, let me drink water. So I said example is regulatory change. You can say location. Is my network? Is it better, please? Can you get me clearly? Is it better?
Yes, sir. We can hear your voice is not breaking. I guess it's the network.
Oh, thank you. So I said example is regulatory change. Maybe they change regulation of don't do this, like the example I just gave, that there should not be secondary school. That will not affect them, Wizkid and them, the video, because it's not their industry. They should remove the old school. No, it's not their business. So another one is management change. If management or leadership should change in a particular place, it can affect people in the industry, but cannot affect any other industry. So unsystematic risk is also called what? It's also called a specific risk. It can also be called a unique risk, avoidable risk. It can be avoided. It can also be called imposed risk. It can also be called alpha risk. So that is visually all I can tell you on risk now. The next thing is, I've been shouting diversification sense. What do I mean by portfolio diversification? Please, for people streaming on YouTube, I think I have space in the class. I think I have about 3 or 4 spaces in the class. So for people streaming on YouTube, you can try to join the class now. I'm sure you should go. I think I have about 3 or 4 spaces in class. So let me talk about portfolio diversification. Or portfolio diversification or risk diversification. What does it mean? I'm saying diversification. See, the way diversification works is, let me just explain to you in basic terms. What diversification simply means is, now, if all the investments you have is in stock, if all your investment is in stock, only maybe you invested in this particular stock, maybe you invested in NNPC stock, you invested in Dangote stock, you invested in Nestle stock, you invested in just like another stock, maybe Boa stock. Now, if anything happens to stock, if anything happens to stock generally, like if there's a particular thing that happens to stock generally, you are on the losing side because it is going to affect all your stocks that you have. Do you understand? Because all your eggs are in one basket. But imagine somebody when they have a portfolio of stocks, they have a portfolio of bonds, they have a portfolio of real estate, they have a portfolio of mutual funds. If anything should happen to stock, nothing is happening to bond. Abi, if anything is happening to real estate, nothing is happening to mutual funds. So what the difference between the two of them is, the person that just has stock, he did not diversify his portfolio. Chamber, he did not diversify his portfolio, but the person that now went ahead and bought stocks, bought bond, bought what's the name? Real estate, bought mutual funds, he has diversified his portfolio. Because now he has removed all his eggs, he has diversified all his eggs from one basket. So if anything is happening to stock, he will be cashing out on bond. If anything is happening to bond, he will also be cashing out on real estate. He has diversified. But anybody that just bought bond, either even if it's different type of bond that you bought, it's not just one bond though. Something can still happen to bonds generally. maybe increase in interest rate generally will affect all your bond. So that's your bond valuation. Increase in interest rate generally would affect all the bonds you have, regardless, even if it's government bond at all at all. Do you understand? So what I'm saying is, but in that anybody that is in that industry, anybody that has diversified his funds will not have a problem because okay, stock is still nothing is affecting stock because of that. Nothing's affecting your real estate because of that. So you have diversified your investment or your portfolio. So you can say, you can just say portfolio diversification is a technique to mix a wide variety of investments within a portfolio. I said you can say it is a technique to mix a wide variety of investments within a portfolio. We have three types of portfolio diversification. We have the horizontal diversification, we have the concentric diversification, and lastly we have what? We have conglomerate diversification. I said the first one we have horizontal diversification. Second one, we have concentric diversification. Then lastly, we have conglomerate diversification. For people that went to Namina U, people that not do dictation in school, all those schools that are at the back of your house, that you'll be going 8 o'clock, that after first class, you come home to come and eat first. This is where you'll be having problem with all this English. So you can just shorten it, HCC. Anything you write in the exam, it remain for your hand. But the first one is horizontal diversification. The second one is concentric. And the third one is conglomerate diversification. Now let me explain. For horizontal diversification now, what horizontal diversification is just saying is, now, let me use a company. Let me just use a company as an example. For horizontal diversification now, a company is expanding by adding a related product to its existing product line. Well, let me come again. I said horizontal diversification is just saying a company is expanding by adding related product or services to its existing product line, although they are usually within the same industry. Let me give you an example of horizontal diversification. People know when this drink, Biggie Cola, no Biggie Cola now. So when Biggie Cola came, it started with just Biggie Cola and Biggie Fanta. Then in the space of 1 month, there is nothing that does not have Biggie. You have Biggie Lemon, Biggie Lime, Biggie, everything is Biggie, Biggie Chapman, everything is Biggie, everything has Biggie. So the exact example is, that's a perfect example. What they've done is they've done horizontal diversification. They've just added a new product to all their product line, although it's still in the same industry. Do you get that example? Biggie, it's still the same technology. It's the same thing they've been using. The only thing that will just be different, that will just differ is the flavor and some of the things they will add. But they are adding a related product. I'm just giving you this example. Any English you want to cook, go and cook it. But I've given you the example. They are adding a related product to their existing product line. Miss Oriofe, please hold on. Let me finish. I'll answer your question. So they're expanding by adding a related product to their existing product. So that's what horizontal diversification is saying. Let me use the second one now, concentric diversification. What concentric diversification is saying is, listen, for concentric diversification now, a company now is expanding in the same industry, but is leveraging on existing technology or infrastructure. I said a company is also expanding. Is expanding in a related industry, is adding a new product, but it is leveraging on new technologies, leveraging on technology, on existing technology, and not new technology now, is leveraging on existing technology and expertise. Let me give you an example. You know, this car company, Toyota, maybe Toyota, they make Toyota Camry, Toyota Corolla, and all those things. So now let's not say they now wake up one day, that they want to make what's the name of this car that Ashake just bought? God of mercy. Somebody should remind me now. What's the name of this car that is trending now? Cybertruck. Then Toyota just wakes up one day and say they want to make Cybertruck. You know that it's not as if they cannot, but they now need to expand to some point where they now need to add more technologies. They need to how would I say it now? They need to leverage on technologies and expertise of some of their staffs to make that new product. But it's still related, it's still kaka, it's still moto they are making. Bami. Another example, let me use Google. You know what Google does now is Google just majorly, for Google is just like it's a search engine. You can just go type clinic on, that's Google. Google is majorly a search engine. So let's say they now want to expand, say, okay, we don't want to do search engine again. Now want to upgrade to, let's say, maybe a mobile operating system or maybe a cloud computing system. It's still the same Google, but they will now have to leverage on existing technologies and expertise to add that related product, to add that new product to it. That's an example of a concentric diversification. But the last one now is conglomerate diversification. What conglomerate diversification is just saying is a company now is expanding into a completely unrelated industry, and it does not even have any business in that industry. A company is expanding into a completely unrelated industry with no direct connection to its existing business. Example, for people that take a company that produces all this beer, you produce beer, all this trophy and the likes. Then the person just wakes up one day and say, I want to start producing foam. I want to start producing motor. So the person is trying to leverage into a different industry that he has no existing relationship with his current product. So that's basically what the types of diversification is saying. Last now I'll talk about is what we refer to as capital market line and security market line. The differences between these things used to come out a lot. That's why I decided to just brand the differences between capital market line and security market line. Please, I would want you to make other researches on it. Please, capital market line and security market line. What I give you is just summary, but please make researches on it, please. So capital market line. What capital market line is saying is capital market line the two of them, they represent relationship between risk and return. The two of them, they measure or they represent relationship between risk and expected return for a portfolio. I said the two of them, both capital market line and security market line, they represent relationship between risk and expected return for efficient portfolio. But the difference between capital market line and security market line is for capital market line, you see that risk that capital market line is measuring, that capital market line is representing. Is representing that risk, is measuring that risk with standard deviation, SD. People that went to Namina you. This is because we're doing standard deviation and all of covariance, all of all these things. So you see. So what I'm saying is they represent relationship between, but the risk in capital market line is measured with standard deviation. Standard deviation measures total risk. Standard deviation measures what? It measures total risk. So you can say that a capital market line represents relationship between a risk that is measured by total risk, measured by standard deviation, between what? An expected return for efficient portfolio. But see security market line. Security market line also represents relationship between risk. But for security market line, his own risk is measured by beta. If you've done CAPM in cost of capital, you know what beta is. Beta is also used to measure risk, but it's not total risk. So do you get? So capital market line uses total risk, while beta uses what? It uses beta risk. Sorry. So that's just basically the two differences I can tell you from my head. So please make other researches on them so that you can do very, very well. That's basically all the theoretical part of the portfolio theory and majorly all you need to know. So when I run through the material, I'll run you through some of the calculative part. I think I have a question in the question bank. That material is not complete, please. So I would, by the grace of God, before our next class, I think I should have had time to complete the material. And some of these things I've said too, I might decide if I'm in a good mood, I might decide to add them back to the material. And also, I'm definitely going to add more questions to the question bank. So maybe 4 or 5 questions. People know the way we did now. So I'll add maybe like 4, 5, 6 questions to the question bank. I'll solve about 2 or 3 in class. People will take the remaining 2 and go and solve by yourself. So before I go into the material, please, do you want to ask me any question, please? Raise up your hand, let me call you, please. Akura Moses, please, your question.
Okay, sir. Please, the last part of the lesson, you mentioned capital markets line. And the second point, I didn't get it. The second line.
Security market line,
Okay.
SML.
Thank you. Thank you, sir.
You're welcome. Please, do you have any other question? Please, if you are streaming on YouTube, I have about 4 or 5 spaces in class. You can join, please. I have about 4 or 5 spaces in class. Please, is there any other question that you want to ask me, please? There was somebody that was raising up her hand constantly the other time. What was her name again? I cannot remember. Please, do you have any question you want to ask me? Nobody here? Sure. I like the people that ask me questions. Sumi Kita, please ask me a question.
Okay, my question is, you say standard deviation measures total risk, then security market line measures beta. What does CML measures? That's capital market. Can you hear me? You say standard deviation measures total risk, and the security market line measures beta. What does CML measures? Capital market line.
That's what you answered now. Said one measure total risk. What are the first things you said?
I thought you said standard deviation is to measure risk. And then CML is for beta. And then SML is for beta. SML is for beta. CML is for what?
CML uses standard deviation. That's what I said. And standard deviation is just like you measuring your total risk. And that is what capital market line uses. That's what capital market line uses. But security market line uses beta risk. Beta risk is not your total risk now. Beta is not your total risk. So yeah.
Yes, sir.
For my next class like this, from beginning to the end, is Yoruba I want to speak. So even all these definitions, I'll be speaking them in Yoruba. So if you don't know Yoruba, or your level. So all these explanations, I'll be explaining them in Yoruba. Diversification, debate, risk. That's what I'll be doing now. So that people can go and learn by force by fire. People are playing with me. I gave some people words to go and learn that time. They did not get back to me. No one. It's when I start solving questions in Yoruba self. Now then I go no. So let me look for the material.
I said I cannot solve questions in Yoruba.
They will soon change.
You will provide interpreter.
They will soon don't be providing
You leave that to next diet. You start that next diet.
Please, can everyone see my screen, please?
Yes, sir.
I can't hear you people. Can everyone see my screen? Please let me know if you can see my screen.
Yes, sir.
Yes, sir. We can see your screen, sir.
Thank you very much. So let me run through the material real quick, please. But I will not do any explaining because I'm sure I've spoken about all the things that I have here. So yeah, I spoke about many of portfolio theory, spoke about portfolio risk, types of risk, I've explained them. Unsystematic risk and systematic risk, I've explained them. Portfolio diversification, I've explained them. Risk return trade-off, portfolio risk return correlation. So this is what I'm going to. So these are the formula. See this formula. I don't know how you want to do it though. Maybe you put it on the, there are some things that you put at the left side of your head or of your brain. Some will be at the right side, some will be at the left side, some will be at the middle, some will be in the front. This one now, I don't know where you want to put it, but I think I'm not particularly sure if it's at the back. Anybody that has checked Pathfinder should let me know if it's at the back, but I'm not particularly sure if it is at the back. But if it is there, if it is not there, I don't know what you will do, whether you cram it, but I'm sure when you start solving, you understand better. So first of all, we have what we call individual assets. Then we have what we call two assets. Listen, we have what we call single asset portfolio. Then we have what we call two assets portfolio. So when you call something one asset, but me, I don't like to, me personally, I don't like to call one asset a portfolio. Me, I like to maybe one asset security. I don't like to call them a portfolio because in my head, I believe that before you can say you have a portfolio, you have to have 2, 3. Maybe it's my own school of thought, child. I believe you have to have about 2, 3, 4, 5 investments before you can say you have a portfolio of investment. But you see in some textbook, even one asset, they will call them a portfolio. I don't know. I don't believe, child. But anyways, for individual security means that you have one asset. But for 2 asset portfolio means that you have a portfolio. So if you want to calculate the risk, this is how you calculate the risk for individual security. If you have only one, or if you have one security, this is how you calculate the risk. So this is your standard deviation. This is the sign. Now I told that people that went to, this is where you split people that went to those kind of school. This is the sign for standard deviation. This is saying equals to your P. P is your probability of your X minus your X bar squared. Your X minus this X, I'm supposed to remove this other one, X minus X bar squared. But for 2 asset portfolio, your 2 asset portfolio is you're saying your standard deviation of, I told you standard deviation is used to measure risk. Don't forget, standard deviation is used to measure the risk. So for your standard deviation of portfolio, you are saying your WX squared, which is your weight of X squared, multiplied by your, people that don't know how to use calculator, you struggle in this class. So please learn how to use your calculator and learn how to use board mass. Standard deviation of X squared plus weight of Y squared, standard deviation of Y squared plus 2, open brackets, weight of X, standard deviation of X multiplied by weight of Y, standard deviation of Y, RX, and Y. That's to calculate your risk. If you want to calculate your return for individual security, your return is denoted as your X bar. Your return is denoted as your X bar. So your X bar is your summation of PX. Your P is your P is your what? Your P is your probability, like I said earlier. This your X is your expected return. This your X is your expected return. So you're just doing summation of your probability multiplied by your what? Your expected return. And for portfolio return is saying your weight of X, RX bar, weighted your weight of Y and RY bar. That's how to calculate your portfolio return. Then for correlation coefficient measures relationship between securities. So it is used to determine the effect on portfolio risk when 2 securities are what? When they are combined. So this is the formula to calculate your correlation coefficient. Correlation coefficient is denoted as R. So your R equals your cov X and Y. This cov is your covariance. It's saying your covariance of X and Y over standard deviation of X and standard deviation of Y. So what this means is you cannot calculate your correlation coefficient if you don't calculate your what? Your covariance. I know some of you ran away from statistics and ran away from mathematics in school. Here you are again. So covariance of X and Y over standard deviation of X and standard deviation of Y. So this is how to calculate your covariance. Your covariance equals to summation of P, X minus X bar, Y minus Y bar. So this is the meaning of all of them. Weight on proportion, expected return of security, correlation coefficient, covariance. This is types of correlation. Please read, all these ones are theory. So this is capital market line, and this is our question bank. Labak Bari, you are done with portfolio theory. Let him away. That is all on portfolio theory. What do you want us to do again? That's all. Let me tell you guys something. I'm sure like just this thing that I've explained, some people are already discouraged. Some people are already like, hey, sure say I go know this thing. Like they've taught me this thing before. I don't know it. I did not understand. Are you sure I will understand it? Like with all this formula with this man just the core for me. Are you sure I will know it? I always tell people, I always tell my students, don't close your mind at the very, very beginning, and don't write any topic off at the very beginning. Don't listen, like learn very well before you can. Let me give you guys a gist. There was something that happened one time when I started my account journey. I started from foundation because I studied biochemistry. So I started from foundation. So I wrote the first foundation exam I wrote, it was a November diet exam. So that time, because I was already writing ATS, but I'd not finished my ATS. I think I stopped at ATS too. So, but I already finished school now, so I could not, and I was serving that time, so I could not complete it. And okay, let me just go and start foundation. But as at that period, I was very indecisive. So they already did lectures to like say August. That they started June. No, they already did an exam in September. I mean, September, I mean November. The exam is November. So they already did classes like August, late August, early September. So about just 2 months to go. So when I joined the center was in Port Harcourt, because that's why I did my sales. I will not mention their name, but center is in Port Harcourt. So when I first started, the very first class I came, we were about two that came together. We were about two that came to class, about two or three. So it was an FA class. So the lecturer, I don't know, I think the lecturer was talking about partnership or something that time. So the man was just on the board, he was talking about, but he already started. So when he came and he saw the three of us, it was not like, he was even very angry. He was like, what is this now? I already told management that they should stop taking new students. Blah, blah, blah. That where does he want to start from now? That he's almost done with his part. He has 1 month to go. But where is he going to start from? This man was angry. The man was parrying for us like it's my fault. I was like, no. So the man now said, okay, let him even see how he can help us. Like, okay, let him see the closeness to accounting so he can know. He asked the first student, I think the first student said marketing. He was like, okay, you can still manage that. He asked the second person said, I think economics. I was like, oh, okay, you can do it. My turn like this. I was in my mind, I was already sad. Because I'm like, this is a full class. The way FA is, people are studying economics, are studying beside me. How do I want to say that I studied biochemistry? Where I want to start from? I told the man, I said, biochemistry. Come and see the way the whole class laughed at me. Like the whole class legit laughed at me. And immediately on that spot, the man wrote me off. I'm not even joking. Like, it was so obvious. At that first sight, he wrote me off. It was that bad that he now said, okay, he now assigned people to just those two people. That okay, he pointed like about, I think, like 2-3 good students in the class, and he told just those two of them that go and meet this so let them explain to you. But he did not assign anybody to me. I'm sure in his mind, what was on his mind was, anybody that he assigned to me, I'm probably going to go and stress the person. So he does not want to be the one that will be in charge or that will be the cause of the person. Do you understand? So like, he did not assign anybody to me. I'm like, what I go can do with my life now? But fortunately, guy man, I made few friends and all. But my point where I'm going exactly is, so during the process, but because of the fact that I already had ATS experience, so I did not really struggle to catch up. And I was very determined. I feel like that was what helped me with my whole account. I was very determined and I hate to fail. You see, say I write exam, I fail. He has a way of doing me that is different from everybody. So I hate to fail. So I was very determined. I started reading and all. So where I'm going exactly is, so in that center, we used to do mock exam. So we used to do mock exam. So in our mock exam, they will give you like normal exam. Like you're writing normal ICANN exam. So we now go to our FA mock exam. So when this man wrote the OFA, the mock exam and all, which I wrote to submitted, but I wrote very well. So, and so there used to now be a special class where they will now do revision of the mock exam. So that's when they will now share the script. And so this man came to class and was sharing the mock exam. He gave everybody their script and he held on to one. So when he gave everybody their script, I'm like, me, I don't even vex my mind. Say, what thing I do this man? You still mark everybody, you know, still mark my script. You what thing I do? This man no one make I pass. Like I was already very angry. That what is this? Then the man was not like, say there is one person's script with him. I'm like, okay, so like, is there anybody that has not seen just I'm like, maybe I'd not write my name. So I'm the one. I mean, I don't even find Bible. Let me go and write my name. So when I stood up, sorry, that's my script, sir. The way he looked at me, it was like it's a lie. Right? I'm like, sir, what is this? What do you mean it's a lie? So what's my name? I said, that's okay. Like the name is not on the script. He said, there is name here that I should tell you. I said, my name is Sulaiman Olanshile. He then asked somebody, are you sure it's his name? He said, yes. He said, come, come, let me show you something. The minute I came, this man hugged me. I'm like, what is happening here? He was like, you got the highest. Like, he said, since he has been in that center, that has been giving mock, nobody has gotten that score before. That is the highest mock score that he has ever gotten. From the person he already wrote off from the very, very beginning. It was not even bad that people that he assigned to some people, he told them to come and use my script for correction. What I'm saying exactly is, I'm not saying this for any applause, but what I'm saying is, don't write off any topic from beginning. That this one, I cannot understand it. This one is too much for me. I hated edging in SFM. I hated edging with passion. But it got to some point where, when I wanted to write my stockbroking exam, I needed it. When I started lecturing, I needed to know it. To now, my aging is hot. It's because I had to go and learn it. I had to learn and learn. So what I'm saying is, I'm sure the way I put some formulas here now, some people are already in their mind. It's be this. Albert Einstein. The people are already calculating a lot in their head. Let's go through that first question in the question bank. Then you see what I'm talking about. Although that first question in the question bank is still a little play here and there, but that's majorly, or that's basically some of the things, or that's the majority of what we'll be talking about. So let's just play with that first question in the next 10-15 minutes in the question bank. Then you guys will see what we are up against. So you know that it's not as if it's difficult or anything. You just need to know it and you need to practice. Somebody should read the first question for me, please. Eka for me. Eka for me. Can you guys hear me? It's not even bad that it's bad that the guys don't even the guys in this class don't even bother again. No, not just they even stress again. Nice one. Nice one. I know what you people are. Anyways, even me, I don't want you. I don't want people to bother before. Thank you. I like it like that. Please, my beautiful women. Please read my question for me. Thank you. But this my women on the former handle.
Iyagbonka is considering.
Yakini.
Iyagbonka.
You see what I want to teach you now. Hey, I'm listening. Yagbonka, I can hear.
Okay, Iyagbonka is considering investment in one or both of two securities, X and Y, and you are given the information below. You have your security, possible rate of return, and probability of occurrence. You are required to A. Calculate the expected return for each security separately and for a portfolio comprising 60% of X and 40% of Y. Assume positive correlation between the possible rates of return from the shares comprising the portfolio. B. Calculate the expected risk of each security separately and of the portfolio as defined above. For this purpose, the measure of risks may be taken as the standard deviation of probable variances from the expected rate of return. C. Outline the objectives of portfolio diversification and explain in general terms why the risks of individual securities may differ from that of the portfolio as a whole.
Thank you very much, madam. See as the voice is subtle. So you want to say you would not enjoy that reading. Send a man read that now. You put here will be paying you already. Thank you very much, man. So the first
you don't want to read. You don't want to hear our voice.
Yeah, it's good like that. Leave it. So the first one is telling us to calculate expected return for each security. I mean, now look at that question. You're supposed to. So we have security X, we have security Y. So we're supposed to calculate return for security X, return for security Y. Supposed to calculate risk for security S, for security Y. They now calculate portfolio return for like the portfolio is for the two. Now the portfolio return and portfolio risk. So let's first say expected return for each security. So let's say security X. This was the formula to calculate return for individual security. Hello, using the material.
Standard deviation.
Standard deviation by return. Risk is standard deviation. Return is not standard deviation. It's in that material.
X bar equals summation P in bracket X.
It's not. Is everything inside? You said what?
X bar or mean equals summation P in bracket X.
In bracket X. So what it's simply saying is that your X bar is referred to. Your X bar is your return, and your X is your expected return. Yeah, let's go. So you say probability, which is the P. So you say probability. You say P. So that probability. In the question now.
0.3.
0.3.
0.4. 0.1.
0.3. You know your probability has to be on 1. 0.3. So you come here. And that means you have 1.00. So the next now, you now say your return. Your return, which is your X. This was the return in the question.
30%.
30%.
25%.
So just say 30, 25.
20%.
Okay. 30, 25. The last one is what? 27. So
Yes.
the next we are doing now is, so you now say your expected return. So you now say expected return, which is denoted as your X bar. Your problem there now, because I have to go and copy that X bar logo. Yeah. Didn't you copy? Dum, 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 dum. So your X bar is usually your is your P multiplied by your X. So multiply your probability by this X.
9.
9.
I don't want you to be looking for figure. No, it's just X, so not X bar.
10.
Sorry, you should be calculating your own. So what's the first one?
9.
9. The second one?
10.
10. The last one?
6.
So don't sorry, what?
Is the percentage here, is it going to show?
No.
Like, are we going to use the percentage or just 30 times 30 instead of times 30 over 100?
Times 30, please.
Okay.
So I have to copy. You don't get chance. So this is the formula we are trying to look. So we are doing summation P over X, summation P times X. So we've done our P multiplied by our S. So we are doing summation of this. So what's the summation of this?
25.
25.
So you can now say, therefore, your X bar X bar is equals to what? 20.
25.
So that's the answer to number one. That's why I told you this thing is very simple. So this is the answer to your expected return for X. This is just the answer. You don't need anything else. So let me leave this one. Let me go and do for security. Why? We'll need another table. For security, why? So you come here and say why? So this one is y bar. Oh yeah, I'm gonna copy. I believe I started calculating. So say P times Y. So yeah, what's our probability?
0.2,
0.2,
0.6,
0.6,
0.2,
0.2. What's our return?
50,
50,
30,
30,
10.
10.
Yes.
10. So what's our expected return?
10,
10,
18.
18,
18.
2.
2,
So what's our
30,
summation of Y now?
30.
30.
So our expected return here is 30. Simple question. Get it back. How many mark? What have I done? How many mark? So that's your requirement one. Or no, no requirement one. A part of requirement one because it told you to calculate individual. So it told you to calculate individual return and individual risk. What we calculated here is just the return. So let's calculate the risk now. So what is the formula to calculate individual risk?
Standard deviation equals square root p into bracket x minus x bar all squared.
So standard deviation equals to your p open bracket x minus x bar. So let's use that. So let's say to calculate individual risk. And copy the formula. So you are saying this. Good. So we already have our what now? So let's continue from here. So we already have our p, we already have our x, we already have our x bar. These are our x bar, we already have our x. So let's do x minus x bar, Abi. So you come here,
yes.
Say for people that did statistics in school, I don't think you have problem with this part. So you now say our x minus x bar. So what's our x minus x bar now? What's our x minus x bar?
5.
What?
30 minus 25.
Yes, ma'am. What is the answer now?
5.
5. The next one.
0.
-5, Abi?
Yes.
Yes.
I hope there is no question. Is this trend? Don't use this one. No. This one is your expected return. This is not your total. Please, somebody is unmuted. This is not your X bar. That isn't X bar. This is just your X bar. Please, this is your total X bar. Summation of the X bar. That's what we are using. So the next one now is X minus X bar squared. No problem. Good day now. If I want to do this squared. I'm really struggling with this. Oh yeah, so what's x minus x bar squared? First one is
25.
25. This is 0.
25.
25. For this one now, we then have So we have P. Abi. Is that not the next?
Yes.
So we then have
Yes.
P x minus x being squared. So probability times this thing. Yeah.
7.5.
7.5.
7.
7.5.
So what is our standard deviation?
Root of.
Yeah, 15.
So you then come here. So you don't see the standard deviation. Tell baby to go and sleep, please. You want to learn SFM? When he gets there, you should not rush. So you now say root of 15. Ah, he gets 15, and now you can cause you. I don't want to be hearing. So what's my answer?
3.87.
3.8730.
No, 2 decimal is fine. So this is just your standard deviation for each security. Is this simple? Is this simple? So let's do the same for our Y. Again, there. Let me just come and copy this one. Oh, but how would I do this Y now? Never like you. You should hold on. Say this. Not do. Gotcha. Oh, what have I done? Just 1 minute though. If I'm using word like this, is not comfortable. For me, Loben. Is that all? Y minus y bar squared. Okay. Okay. Yes. Let me not copy this one. I hope some people are already giving me answers. I'm starting like the girls giving me figure new. I don't get chance. About this stuff. So yeah. So we've done this. So let's start from. So let's do y minus y bar. So what's the first one? What's our y minus y bar for the first one?
20.
20.
Second one.
0 and minus 20.
So we'll do y minus y bar squared, don't go. So this 400, am I correct?
400. 400.
So for the first one,
80.
multiply by probability.
80.
0.
0. 80.
160.
Good answer.
12.6.
As easy as this. As easy as this. Oh yeah, let's go calculate. That's requirement 1. So requirement 2. So we should calculate. I think return and risk of the portfolio. So let's just calculate portfolio return. So you say the portfolio. Those formulas calculate portfolio return. Down. Those formulas calculate portfolio return now. Hello.
X bar equal, is it for individual or for, okay, portfolio return? RP equals WX RX bar plus WYRY bar.
So let's start. So what's our weight of X?
Okay, weight of X.
Is in the question.
Hello, good evening,
Yes,
sir.
let's give me a second. Somebody is disturbing our class. Manuela.
Weight of X
60%. 60%.
There's noise coming from somewhere. But anyways.
Sleep. Lie down, sleep.
So you daily leave that boy. Which one is sleep? Sleep, lie down. I beg you. Oh yeah. It is 60%, so 0.60 multiplied by what's our return? Our expected return for X.
25.
Thank you, madam. Don't tell him in here. So for this other one, weight of Wanko
0.4.
4.4.
So what's the return from
30.
So what's my portfolio return?
27.
Don't equals to 27. Lobaton. Simple as ABC. This is easy.
Sir, it's not easy.
That we are just doing portfolio return and all of all the simple ones. Simple now.
Sorry,
So
excuse me. Sir, please, where is the 25, the return, the 25% gotten from? Because I'm looking at the question I have, I can't find it there.
that was the first thing we calculated now. It's the first thing we calculated. This answer now, this 25 answer that we got from here. Have you seen it?
And 30.
Mm.
Yes, thanks. Yes, sir.
Oh yeah. So what's the weight of X squared? That's 0.6 squared, Abby.
Yes.
So multiplied by what's the standard deviation of X squared? What's the standard deviation of X squared?
25.
Yeah.
3.87.
3.87.
The gamma then blow you, hear me.
3.87.
Like that's standard deviation now. You know, I told you that this is where we will know people that went to Namina and people that went to know all these schools that the Rosebud, Christ ambassadors, all those sweet names, and people that went to Anoluwa, Tinuengo, Ololuwa. This is where we will know.
Standard deviation is 0.87.
I lie. Let me ask you a question. What's the difference between standard deviation and variance?
Oh, variance is the square of standard
Square root,
deviation.
square root of the standard deviation.
Okay. So what is now my
No, standard deviation is this.
Is the square
if you want to, they say variance is the square root of standard deviation. Where then?
No.
The standard deviation is the square of variance.
Square
Root of variance.
Size 15.
Square root of his variance. That is standard deviation.
The square root of variance.
The standard deviation is the square root of variance. So when standard deviation is the square root of variance, automatically means variance is what?
15
is the
square of standard deviation.
Get there, by.
Yes.
For people that don't, let me explain what we said. Standard deviation normally, please, somebody is unmuted and is echoing. The place is noisy. So what I'm saying is, for people that don't understand what we are doing, is Miss Fetia, you're the one. Fetia duty. Thank you. So what we are doing is we said that, or we know that standard deviation is what? It is the square root of variance. Standard deviation is the square root. So automatically means variance is the square of standard deviation. So this thing, this standard deviation square, it means they're asking you for the what? For the variance. And if you look at the question we've done here, this is the square root before we go to our standard deviation. So this means that this is our variance. This 15 is our variance in this situation. So 15 is our variance here. I hope that is clear to some point anyways. I won't come BB want to dx square. So but if you still do it, I think it should give you 3.87 square, should give you 15 now, Abi.
Yes, to give you 15.
So you can do 15, but you can still go and use 3. Let me use 3.87 square. I don't want problem. But you'll be giving me double work, sir. Anyways. So yeah, what's our width of y squared? That's 0.40 squared, Abi.
By 160.
Is it 160? No, it's 12.65 now. You can just use 160, but because I'm trying to explain, that's why I'm using it full. So plus 2, this one is 0.60. So this is where you now have your standard deviation going of what's standard deviation of x that will go 3.87, have you?
Yes.
0.40. 40. What's the standard deviation of y that we got?
12.6. 12.65.
Right. So what's the return of x and y?
30 and 25.
Lie.
Need to calculate it.
Lie. What's the meaning of Rx and Y in the question? Check that material. What's the meaning of Rx and Y? The Rx and Y is your correlation coefficient now. And in that question, in this question, I've not heard anything like correlation coefficient. So if you don't have correlation coefficient, you put it as 0 now. The correlation coefficient is in the matter. It can either be positive, negative, or 0. We have a positive correlation, we have a negative correlation, we have 0. The correlation coefficient is usually 1. So if your correlation coefficient is positive, you'll be +1. If it's negative, you'll be -1. And if it's 0, you put 0. So this question, there was no correlation coefficient, so you put 0. You need something good. So yeah, people that went to good school, please calculate it for me. Let me see what you have. So
Sir, they
you?
mentioned the positive correlation in the question.
They mentioned it.
A positive correlation in the question. They said positive correlation between the possible rates of return from the shares comprising the portfolio.
Yeah, but they didn't give you a figure now, so you cannot just
Okay.
put. But even if you put
I thought
oh, it would make a total different answer first. But because there was no exact figure, don't
okay.
put anything. Okay.
I'm having 11.76.
I got 5.57.
What is figure you are getting? Oleo. So what did you so this is what you should have. So let's do it one by one, please. My time has gone 11:30. Did I record this class? You kind of cry. I will just cry now. Oh, thank God I recorded it. I will just cry. People that are streaming on YouTube, there's space in class, so if you want to be here. So let's do one by one.
It's 5.7, sir.
Yeah?
It's 5.57.
Is it the first one, everything?
Everything.
Let's see now. Let's see if you let's see if you went to good school.
5.57.
So for the first one, what do you have? That's zero small. For the first box, what do you have?
5.5.
Cannot hear now.
5.39.
No, 5.39.
5.4. It's 391,684.
For the second one, go.
64.
25.60.
25.60.
Which other than
25.
So what's this one?
That is 0.
Anything you multiply by 0 will give you 0. People that went to Namina UPM school, anything you multiply with 0 will give you 0. So what is my answer?
5.57.
It's now give us 30.99.
30.99.
30.99.
And square root of it?
Yes.
Yes. Then the final answer is 5.57.
You said you have what?
30.99.
Yeah. 30. No. What do you say I have?
5.57.
5.57.
Go back down. As simple as ABC. Simple as ABC. You see, yeah, the good thing about some of these questions is You see this correlation coefficient. Sometimes, I said they will give you figure. Sometimes they might not give you figure. They might not say correlation coefficient is, but they will not give you information relating to your what? Relating to your covariance. See and get me. If you check that, if you check that covariance information, if you have your information for covariance, you can calculate correlation coefficient. If you check that information, if you want to calculate your correlation coefficient equals to your covariance of x and y over your return of x and y, Abi. So if they give you information for covariance and you already have return, you can use it to determine your correlation coefficient. But because there's no information relating to covariance here, it's actually another reason why I can assume 0 to be my correlation. But if there's information related to covariance, I would advise that you go ahead and calculate your covariance first. Then use that information, whatever you get, use it to determine your correlation coefficient, and come and use it in this place that you used 0. Baton. Are we done?
Hello, sir.
And I know there is a, please just raise up your hand if you want to ask. And I know we have number 3, which says, please just signify, Madam, I'll call. So I know we have number 3 that says outline the objectives of Bugoyamuti solve. So that's your assignment. Even though I cannot live without giving you assignment. So that number C part is the assignment. So I've outlined the objectives of portfolio diversification, explain in general terms why the risk on individual security may differ from that as a portfolio as a whole. Why you see me? Maybe I don't understand Yoruba. That's my assignment.
You
I don't
speak
care.
Yoruba too much. I don't even understand what you're saying. Okay?
Good. It's wickedness. I don't want you to understand none, and it's not fight. So what I say is do the assignment and snap and send to me. And nobody's fighting with you. Anyways, please, if you have any question regarding what I've just done, please ask me my questions, please.
Good evening, sir.
Akura Moses, you don't want to put your hand down since morning. His hand not pinning you. Because if it was physical hand, sure you would have not put it down since. So Chika, please, your question, please.
Good evening, sir. Thank you for
Good evening.
From
I can't hear you.
From the calculation you completed above, I'm having a different answer.
From which of them?
The last one you solved. The portfolio.
One is the last one. Or this one?
Yes.
So what do you have? You don't go get Canada or UK.
No, I'm
I'm
getting
listening.
27.92.
For which one? For which one, madam?
For the last one you solved.
This is the last one. A lot of figures everywhere. Which one are you? Which one didn't you get? Instead of what, though, madam?
I'm having 27.92 instead of 30.99, sir.
30.9. Okay, yeah.
Yes, please.
There's no how you're having 27 now. If you're having 5.39 plus 25, that's already 30,000. So if you use normal eye contact, 25.60 plus 5.39. It's giving you 13. I cannot give you, there's no way I can give you 27. Even eye contact, go 25.605. Yeah, that's 30.99. It's correct.
Okay, let me check. Thank you.
You're welcome. Yeah, don't tire. Mr. Walter, please, your question, please.
Okay, sir. Please, I want to clarify. These things we solved, is it A? And where did B start from, please? Don't be funny.
What? Is what? I didn't get that.
I asked, this thing we solved now, where did A start from? Where did B start from?
Where he is. Don't go down. It shocked me. Let me look for it. Bro. Okay, this is number 1. Now this is where the B part starts from. This number 2, where we calculated the risk and return of the portfolio.
Okay. All right, thank you, sir.
You're welcome. 1 minute, please. Okay. Yeah. What do I mean? Oh, yeah, another question. Okay, Chuku, please, your question, please. Okay, Chuku.
Sorry. Thank you, sir. Please, this zero, I don't know how comes about this zero I lost. I just stepped out.
I didn't get that. I cannot hear you, sir. I think your network is breaking. If you can put your question.
Hello, sir. Can you hear me?
I think it's better now.
Can you hear me, sir?
Can hear you.
Can you hear me, sir?
Yes, I can hear you.
Okay. I said, how comes about the zero?
What?
Yes, I said, how comes about the zero? Zero.
What zero?
From our computation.
Yeah, what happened to the zero?
I said, how comes about it, please?
It is the formula is Rx and Y. Now your Rx and Y is your correlation coefficient. I would not have correlation coefficient in the question. That's why we represented with zero.
Okay.
It's
Okay.
from the formula Rx and Y means correlation coefficient. And we don't have information relating to correlation coefficient in the question. So I kept this as zero.
Okay.
Yes,
Thank you, sir.
You're welcome. Chika, you don't have any questions. The former one now. Chika Maker.
Oh no, it's another one. Please, sir. I just joined the class not quite long. But please, can you drop the note for us so that I can follow through if there's any question?
The notes are always dropped now.
Okay, I'm sorry, I've not gotten it before.
You've not gotten the notes before?
No, sir.
Oh. I always drop the note and the solution. Everything will be, there's nothing I'm using them for now. So immediately after the class, I always drop the note and the solutions for you.
Thank you, God.
And the note I already even dropped. Sorry. I've dropped the note before. So it's just the solution I'll drop now.
Yes, it's the solution that I'm talking about. No.
Okay, I'll drop the solution. Please, do you have any other question, please? So let me go into the chat box. The formula is long. At this moment, go carry this formula. Enjoy your class. Okay. The assignment is the third question in the chat in the question bank now. You people are supposed to be buying me Martina and Mick after every class because people should drain my energy. Is the number C in the question bank now? That's the third question. It's number C in the question. That's what I told you to go and do. So I told you to do it. It's theory. So you can just do it and snap for me. And you can decide not to do it, and you can decide not to send it anyone. It's just theory parts now. So you can just go into it. So the madam that said I speak Yoruba too much, this is what I said in Yoruba language, in English language. Thank you very much. I hope I don't have any other question, please. Okay, so I will take that as a no. So on that note, next week Monday, I would add up more questions to the question bank, and I would so I'll just add up more questions and more things to the material by the grace of God, so that we can continue from there next week Monday. On that note, thank you guys very much for listening to me. Have a wonderful night rest and have a wonderful week. Good night, everyone.
Good night, sir.
Thank you, sir.
Thank you, sir.
Bye.